So many questions on whether this time around we can really trust your forecast. What are your models? Are your models broken?
Well, I think you have to see our forecasts against the background of the news we're facing and the magnitude of changes in developments in the economy. So as I think was emphasized by my colleagues who spoke yesterday, even since May, we've seen a doubling of the sort of relevant measures of wholesale gas prices in Europe. And we know that those are the key elements that feed through into energy utility bills that households in the UK are going to face. And, you know, we've made the calculations on the back of the announcement that was made yesterday morning by Ofgem. And that suggests, as we've reported in our publications yesterday, that you know, the cap will rise to £3,500. I mean, it's only 6 months ago, it was less than £2,000. Yeah. So I think we have to understand that the scale of the shocks affecting the UK economy, particularly affecting the households in the economy, are really very large. And our forecasts have to change to reflect that. When we're taking policy decisions, we're not prisoners of any single forecast. Yeah. And I think one of the things that was emphasized yesterday by the governor is we've done a range of analysis with different assumptions about energy prices, different assumptions about interest rates and so forth. And across that set of analysis, there are certain key messages that come out. Yeah. First key message, I think, is that across that range, we will see a recession. The recession is the consequence of energy price rises we've seen in the past.
Well, 5 quarters of a downturn, right? Yes. It's more than a recession. It's like a protracted downturn.
Right, and I think that's a reflection of the magnitude of this increase coming from energy prices into household incomes here in the UK. And the second thing is we will see inflation go up, because the other side of this increase in energy prices is the increase in inflation. And then the third element is, and this is what the governor was just referring to, is in all our analysis, partly due to our own efforts, but also on the assumption that energy prices will eventually stabilize, we do see inflation coming back towards target towards the end of our forecast.
Is this worst case scenario, so a gas embargo, and is it also with possible, you know, fiscal expenditure from Liz Truss if she becomes Prime Minister? How difficult is it to know what the Prime Minister does, the next one?
Well, I mean, I think there are two things this year. On the energy prices, our baseline scenario is just based on the assumption that we follow futures. We can see those on your screens for the next 6 months, and then we lock that in. That is locking in gas prices, oil prices at historically high levels, which persist indefinitely. Yeah. And for the UK, which is an importer of energy, that implies that there is this prolonged squeeze on real incomes, which is a big feature of our forecast. Regarding the fiscal side, of course, I mean, we're in a slightly complicated, shall we say, political situation. I'm not going to comment on that, as others have not either.
But it changes everything.
But I think a key thing is we are making an assumption in our forecast on announced government policies, the most recent of which is the May adjustments that we've seen for addressing the gas. But crucially, I think this is important, is, I'll repeat the same thing again, we are not prisoners of the baseline published forecast yesterday. And in thinking our policy, we are, of course, taking into account risks to all these conditionally assumptions, including the fiscal.
But inflation also feels much more embedded, right? So at what point is it to a point of where there's a spiral and it's almost impossible to keep control of it?
Right. So I think your point about embedding, that is a key point. So when you say it feels much more embedded, the reason why inflation is going to 13% in our forecast is not really of itself an embedding story. It's a story coming from energy prices. The direct effect of energy prices on inflation over the next year at the peak amount to about 6.5 percentage points. The indirect effects, the fact that energy price rises mean it's more expensive to light the studio and so forth, so feeds through into service. We think that's about another third. Right. So around 8 to 9 percentage points of reaching 13% are coming really from this rise in energy prices. You're right, though, that what matters for us, what we can do something about, as we've emphasized in our statements of late, is that persistent component of overall inflation, that part of inflation that is still there into 2-3 years' time, that is still able to be responded to by policy decisions we take today, given the lags that it takes for our policy decisions taken today to work their way through to price development.
We did a bit of research. You know what's the most Googled question on Google for the UK economy today is, do I buy a house price right now? Buying a house during a recession. Should I be buying a house right now? What impact does this have, given mortgages are going up, given it's, I think, £1,000 more expensive for house buyers paying that mortgage on average? What does it mean for the housing market?
Well, housing market, first of all, I wouldn't overemphasize from the point of view of our assessment of the economy. I mean, the housing market is important, but it's not something we would give a status to beyond the other important elements. I mean, of course, fundamentally, what we are trying to do with our interest rate increases is to slow the momentum in the economy in order to contain inflation. I mean, that's what the agenda for monetary policy is right now, given inflation is so high and the potential persistence there. Part of that will be operating through and via the housing market. I mean, you mentioned the point that mortgage payments will go up. I mean, what I'd again emphasize is what you say is true. That is part of a process that is slowing down the housing market, slowing down the economy. But it's also true that is smaller than the impact of this rise in energy prices, right? So I think we can distract ourselves from the big story if we begin to the way I would see it is, the way I'd emphasize is, we've seen this big shock to energy prices that has pushed up inflation, squeezed incomes. There is an interest rate response to that to constrain inflation, and that is partly working through the housing markets, which we would expect to cool. My colleagues on the financial stability part of the bank, of course, do their own analysis, and at the moment, at least, they think there's some resilience there. We're not expecting to see the sort of dramatic downturn that we've seen in the past.
Given what you've just beautifully explained, how likely is it that we get another 50 basis point hike in September?
Well, we're going to take decisions, as we always do, but I'd emphasize one step at a time, one meeting at a time. So I don't think you can read in to subsequent meetings the fact we made a 50 basis point change. And I'd caution against that. I think a careful reading of our statement yesterday would be consistent with the view that, as I think I said last time I was here, we're trying to ensure there's an element of flexibility in the framework. For two reasons. One, there is a diversity of views across members of the committee, which needs to be encompassed. And for any individual on the committee, at least myself, given the uncertainties we face, I think we need flexibility either to go further or to stay where we are, and the pace at which we go further to be varied according to circumstances.
Do you feel like you're behind the curve? I mean, I know that a lot of the UK press are going after the bank.
Yeah. I mean, I don't think we're behind the curve. I think a key element here is when you think about the persistent element of inflation that we're focused on, that's an element which by its nature is a slow-moving element. If you think about the impact of monetary policy, because of the lags that are in the system that I just mentioned, the impact of monetary policy on the economy is a slow-moving phenomenon. So what we're trying to do here is match those slower-moving developments in persistent inflation with an appropriate impact of monetary policy. And I don't think that is something that is about 1 month here or there. That's about something that's going to last over a period of years.
But how can the bank be forward-looking if, you know, inflation and employment are basically lagging? So you see them too late.
Yeah. Well, we can be forward-looking because we make forecasts. I mean, as I said, and as the governor said yesterday, those forecasts are difficult now, given the uncertainties we face. How can we make our decisions more robust in the face of those forecasts? Well, we look at a variety of different analyses. We look at a variety of different scenarios. We published many of those yesterday. And crucially, I think what we're trying to do is always extract from this broad set of information we see that component which informs us about this persistent element of inflation that's still going to be there in 2 or 3 years' time.
Hugh, the bank did also get some praise in saying, like, look, you were the first ones, you were honest, you're you know, painting this very complicated picture with this pretty horrific recession. Longer term, do you think interest rates in the UK will be higher than in the US and the ECB?
Well, I mean, what's key for us is that we get inflation to target. If we get inflation to target, then interest rates will be, we hope, broadly speaking, at some slightly positive premium to that level of inflation, reflecting real returns in the economy. So, you know, the real rate of interest is the nominal rate of interest that we're setting, take away inflation. That gap should be positive. We were not expecting a repeat of the experiences of the past, of my childhood, where interest rates were going sky high. We think that the sort of the equilibrium level of interest rate, if you like, that's a very vague concept, difficult to estimate, but we think it's much lower now than it was in previous episodes.
So around what level?
Well, I mean, I'm always cautious. You've asked me that before, too. I'm always cautious because I think it's a very uncertain level. In nominal terms, right, so just to emphasize, if we, as we're intending to do, and I expect us to do, and people should have confidence in us doing, if we get inflation back to target of 2%, then nominal interest rates will return to levels, broadly speaking, in that kind of range as well.
Okay, do you see interest rates peaking around 3%?
Well, I know that's what markets are currently pricing.
Yes.
I don't want to be pinned down. We will do with policy and with interest rates as our active instrument what we need to do in the light of events, in the face of circumstances, on this meeting basis that I've described, in order to achieve our target.
I know you don't want to be pinned down, but are they off, or are they pretty much in that range? What are markets getting wrong?
I'm not sure markets are getting too much wrong. I mean, personally, I think we are in a process of transition from a long, prolonged period, basically since the onset of the global financial crisis. That's almost 15 years ago now, from where monetary policy has been very easy. Monetary policy has had interest rates close to their lower bound. We've been doing QE. We're clearly extracting ourselves from that period, which lasted for a very long time, as the world changes. That process of extraction requires a certain element of caution because there's a danger having gone, in a way, from one extreme with monetary policy. I think we have to guard against, like, falling into the trap of going to the opposite extreme. And, we're in a process of trying to calibrate interest rates, calibrate our policy stance to achieve our goal in a challenging environment, but in an environment where there are risks on both sides. There's a risk of doing too much and exacerbating a recession and prolonging a recession, which we think is already going to be there. There's also, of course, a risk of doing too little and allowing inflation to become embedded. So we don't want to oversteer, we don't want to understeer.
What's the less mistake? I know there's like a Goldilocks, but...
Right, well, of course, I mean, in assessing whether we're oversteering or understeering, we are thinking about those risks. Yeah. At the moment, I mean, our policy decision reflects the fact that this fear of embeddedness is one that we have to respond to more.
Hugh, I could speak to you for like an hour. I only have 1 minute on QT. How should we look at QT? So, first of all, is it really that difficult to give the correlation between basis point in terms and how much QT impact will have?
Right. So I think there are two questions there. First question is it easy to give you a number, whatever X basis points? I think that is a very difficult question.
Yep.
And it's a difficult question because, as we have published in our own document a few months ago, I can hear the music. So you want me to stop? The short answer is, I think QT will probably have a tightening effect. Yeah. It'll come through asset prices. We will see those asset prices. We will set interest rates incorporating those impact of those asset prices in order to get inflation back to target.